And off to you, Peter.
Okay, great. Yeah, thanks, Pascal. Pleasure to be here. Just as a standard protocol for any kind of recorded transmissions, is a it's sort of typical on Twitter and YouTube. This is not to be considered financial advice. I'm merely offering my opinion on market moves and other geopolitical activities. Uh, welcome dissenting opinions and questions after I guess I begin speaking. So there's no pre-planned plot here. The problem I have is I can go off on a tangent and go on tangent after tangent. So I'll try and keep it focused, but really this is sort of a global outlook picture for 2024, where I sort of see things going. Um, it's complicated by the fact that the world is becoming increasingly interesting. It's like the Chinese have cursed the world with interesting times. This is a very unusual period in history, specifically for the last for my entire career. I've never seen so many what we call black swan type risks, and so it makes it very challenging to try and understand what the heck's going on half the time. So, but anyway, I mean, what are the general themes that we have here? We have a situation where the world has had several significant financial events over the last 20 years. So as a result of, let me start back. This is the problem. So if we take a look at where things have sort of gone awry, well, we can go back to 1971, and Nixon took the U.S. off the gold standard. So what happened is you basically get into a situation where you have central banks managing the economy through fiat currency. And the problem with fiat currency is it's not backed by anything but the good faith of the government. So, in order to have credibility, you have to make sure that people believe that they're not going to lose value of their currency over time. And as a result, central banks have had to act in various ways to, establish their credibility. So we saw in the 70s, inflation was taking off in the US, and Paul Volcker, the head of the Fed at the time, raised interest rates dramatically to try and stop that. And so we had a period in early 80s where we had extremely high interest rates relative to historical standards, but that got inflation under control. And of course, inflation was a problem because, again, Nixon went off the gold standard. They were printing dollars to fund the Vietnam War. And then we had two OPEC shocks, which caused a rise in energy prices. And energy prices are a prime contributor to the entire price supply chain. So it took Volcker to basically put the economy into a coma in the early 80s, and subsequently, that reestablished some sort of faith that the currency wasn't going to be printed to death. But needless to say, throughout the late 80s, financial excesses seemed to recur with disturbing, consistency. And so we had the savings and loan scandal in the early 90s, and they had the Mexican, Latin American debt crisis, and then you had the Russia defaulting late 90s and long-term capital going bankrupt. So every instance of this, the Fed basically went against their one mandate of, price stability and inflation control and, guaranteeing employment. And oh, we've got to be the market's backstop. So what you saw come into effect was called the Greenspan put, which is basically the Fed will not let the market, go to hell. It will intervene in some form to reestablish confidence. And we saw this, 9/11. We saw this, year 2000. And it's gotten consistently worse. In 2008, of course, we had the financial crisis, which enabled the Fed to do something it hadn't done before. And really, when my time at the central bank, this was considered to be, it's old school thinking now. But when I was at the central bank, you would not print money to monetize your debt. You would not be creating money to buy bonds. And yet, that's exactly what the Fed decided to do in 2008. Notably, the Bank of Canada did not do that in 2008. That was one step too far for the Bank of Canada at the time. But the repercussions of that were significant. The Fed's balance sheet went from $1 trillion to $4 trillion through successive quantitative easing programs, where basically the Fed is printing money and buying bonds, so injecting cash into the system by doing that. And that cash came out of nowhere. It's not backed by anything physical. Again, it's just full faith of the government. And It had stimulative effects, and really, I guess one of the issues that we're dealing with now, and like you see a lot of financial commentators saying, all-time highs. How's this market at all-time highs? There's a crash coming, and yet we continue to see markets rally. And why? And one of the prime reasons for this is just the amount of liquidity that's been created since 2008 has been dramatic. So going back to what the Fed did, they created a balance sheet issue where their balance sheet blew up by quadruple times. So throughout 2000 and say 14 to 2017, the idea was Fed's got to revert to some more normal conditions. They're going to try and normalize their balance sheet by slowly selling off some of those bonds, and they didn't get very far because you had various disruptions to the economy, such as Trump's tariff wars. Uh, and a variety of other things. The market had basically got addicted to liquidity, and the Fed was trying to take away the punch bowl, and as they typically do, but they're trying to raise rates at the same time they're also selling the bonds they had bought, and so you're creating a overly restrictive environment. So they wound up in 2019, September 2019 to that September 16th night 2019, there was a repo crisis. And what this is indicative of is the Fed basically had taken too much liquidity out of the system. The market couldn't deal with it. There were other issues around that time period, but basically the Fed had to come in and offer overnight liquidity to save the financial markets once again. And this is kind of interesting, and I'm going to get ahead of myself, but yesterday the Bank of Canada is actually doing sitting at repo operations, and why? Because the same reason they've been doing quantitative tightening to sell back all those bonds that they bought in 2020, 2021. And I'll get to why they started doing that. But I mean, it's the same thing that what happened in 2019. So they're trying to normalize conditions, but it's a very tricky process. When you inject all that liquidity, the market gets hooked on it, and now you're taking it all back, or you're trying to take it back. It doesn't work very well. It causes disruptions. So anyway, in 2019, we had the repo crisis, and then we walked into 2020, and so the market was still unsettled, and then we had COVID restrictions hit. And I mean, the weird thing about that was it sort of was telegraphed. We knew things were bad in China in February 2020, yet markets in North America didn't react to late March 2020. And then, of course, when they did react, it was extreme. And we saw extreme measures by the central bank. So if I thought that there was too much liquidity in the system prior to 2020, well, I said the Fed got their balance sheet from 4 trillion down to 3.7 trillion or so. And then, we're off to the races in 2020. Basically, rates cut to zero, and massive quantitative easing. So the Fed's balance sheet went from 3.7 trillion to around 9 trillion. And I mean, what was interesting, as I said, the Bank of Canada in 2008 didn't react. And yet in 2020, they saw it was such an extreme situation that they had to violate their own best best analysis and actually quantitative ease as well. So I said Canada started doing massive money printing and buying Canadian government bonds, and at the same time there was a massive fiscal stimulus from both most industrialized countries, Canada and the U.S. included. So again, you're pumping in massive liquidity into a system that already had too much liquidity anyway. And when I say too much liquidity, it was evident, like, for example, in Europe in 2018, you had 30-year German bonds trading at a negative interest rate. You had a bank in Denmark actually issuing negative mortgages. So you're getting paid to take a mortgage. I know people in Holland that right now, they have like ridiculously low mortgage rates. It's like, that's a legacy from, locking in at near zero or negative rates a few years ago. So what this means is like, when you have so much money chasing in, what Greenspan used to call rational exuberance is really just like, well, rates are low. I've got to start buying something with a yield. So in the U.S., instead of buying good corporate names, people start buying junk bonds because it's like I can't survive on a 1% return a year. I need to make more than that. So they buy riskier and riskier assets. And so all this liquidity has basically prompted a sort of extreme, fundamentals don't matter anymore. And I mean, it really comes to a case where if you have interest rates low for a long period of time, and yet you have inflation that's higher than your interest rate, you have a situation where you could have negative real rates. And when you have negative real rates, you have very difficulty trying to value future cash flows. So the entire premise of fundamental analysis and equity valuation goes out the door. And as a result, as I said, in Europe in 2019, you had people chasing, buying German bonds at negative. Well, and why would I buy a bond that I have to pay to own? Well, because you're expecting a capital appreciation, and that's what's been going on with a lot of stocks. Is like this uh, share price to earnings is ridiculous, but you know what? It's going up in value, and you had things like GameStop in 2021, and the result is because liquidity encourages all kinds of extreme positioning, and for example in 2020, one of the things I talk about a lot on LinkedIn is basically the ability for hedge funds and such to use all this liquidity the banks are providing because the banks have to do something with the capital they've been given. And so they take these very large short positions, and it's been interesting. It's 2021 in particular, in 2022 there was it wasn't just one or two stocks that were being shorted. It was widespread shorting across a wide range of industries. And we saw that last year in March 2023 when liquidity problems in the banks, and again, I could go on with very different topics, but what happened was we had the regional bank crisis in the US where the people were leaving the banks because they weren't getting enough on their savings deposits. They're going to money market funds, which with the Fed raising rates, 5%, that caused a capital outflow. So you've got banks that are basically having liquidity problems. They have massive losses on their bonds because again, they've been buying these long duration assets at very low rates, and the Fed starts hiking rates again, and they have huge losses that they need to basically put it on their balance sheet as a whole to close position, or they can't sell it. If they did sell it, they take a massive capital loss. But so they're struggling for assets, and the Fed had to with the Treasury create a facility to basically a pawn shop to park these bonds to get 100% collateral so they could get cash. But anyway, this all was apparent to the shorts, and they're selling the crap out of the regional banks, and as a result, you had three or four regional banks, some of significant size, fail last year, and a large part of it was the shorts were it becomes a vicious cycle where you see a bank in trouble, you're going to short it, their price goes down, they can't do a share issue because they can't raise capital because the share price is too low, but they don't have enough deposits to deposit leave them building. So you had a curious thing where the Fed has been ignoring all the shorting going on in a lot of different industries, but all of a sudden, when the regional banks are being targeted by the shorts, it's like, oh, we're going to take a look at this. And funnily enough, things sort of quieted down, and we got through the rest of 2023 without too much major bank problems. But this whole story I just told you is just encompassing of what happened with all this liquidity. It created misalignment in risk taking, and in not just shorts, but in all asset classes. And then the Fed basically encouraged this by saying we're going to keep rates low for longer. The infamous inflation's transitory, and it turned out it wasn't. And why wasn't inflation transitory? Well, inflation wasn't transitory because the well, I mean, there's different explanations. I mean, one obviously was the supply chains were got completely wrecked into COVID, and it takes a long time to either replace them with something else or rebuild the existing one. I mean, just the number of people displaced from different industries, the spike in crude to 125 in 2022, and the resulting transport costs, which again, like in the 70s, we saw that inflation spike. So it should have been no surprise when you see crude at 125 that going from like $50 or $60, whatever the market had gotten used to, and you see a double in crude in a few months. And don't forget, actually, it's like one point crude was like almost negative in, I think, March 2020. You had to basically, well, it only lasted for a few days, but I mean, that just to give you the extent of how crude prices have changed over time. It's like, so this is a dramatic spike in prices in 2022. And as a result, yeah, I mean, yeah, one of the causes of that was obviously the Russia invading Ukraine. That caused, significant supply chain issues as well. And there's been a realignment of resources and all that. I won't get too into it, but the fact is that the supply chain issue causing prices to rise in crude, and then that caused all kinds of other prices to rise. And that's why we had inflation. It's not transitory. And I mean, just look at all the stimulus too. It's like when you put that much money printing to work, it's inevitable that it's going to be inflationary. So for the central banks, especially the Fed, to say it's transitory, that was either gross incompetence or total gaslighting. And I do not believe the Fed is that stupid. They have what, 200 PhDs on staff. Uh, it has to be, it really has to be a case where they were trying to get the market not to be worried about inflation. But ultimately, we saw the data creep up and accelerate. And at that point, again, there's no the problem with a fiat currency system with nothing backing it. Once inflation gets going, there's really nothing to stop people from freaking out. And we have too many historical examples, such as Weimar Germany or Argentina, or, and recently, it's like once inflation gets its root into the economy and people expect it to keep increasing, it becomes a very dangerous thing. So the central banks have to react. So even though all this new debt had been created, all these people had bought, investments at ridiculously high prices, then the Fed still had to hike rates because the inflation credibility was significantly at risk, and it still is at risk. I would personally say that they've ruined their credibility. But the fact is that they had to hike rates. They had to hike rates more aggressively than they have historically. And this is, again, what caused sort of the problem I talked with the regional banks. Is like you have a lot of investment managers that had a lot of long duration bets, basically buying 30-year bonds because that had a higher yield than 5-year bonds. Uh, and as a result, they all took huge capital losses. And I was talking about this in 2018 with regards to Europe, but it holds true to what happened in Canada and the US as well. So you've got massive problems. This sort of displayed itself in the UK a year ago with the pension system almost collapsing. So yeah, there's significant problems with all this liquidity that was created, and now the Fed created this liquidity, and now they're taking it away or trying to take it away. And as I said, the Bank of Canada is dealing with that right now, trying to take away all the stimulus they put into the bond market, and the market's not liking it. And I guess that leads us to where we are right now, is trying to figure out, well, what's going on. Historically, if you saw rates go up this fast, and it's, so there's two stories here. In the U.S., the concern is, well, with a concern everywhere is, if your interest rates go up and you've got a mortgage, how are you going to maintain your payments? In the U.S., luckily, they have the ability to lock in a 30-year mortgage rate. And a lot of people did lock in a 30-year mortgage rate in 2020 and 2021. So from that sense, it's a good thing for U.S. homeowners because they're not subject to reset risk. They can sit on their 2% mortgage and they're laughing. The problem is if they lose their job and they have to find an equivalent job, they have to move to a different state, or they have to sell their house. Well, then they have to buy a new house at a much higher mortgage. So they're basically, the only thing that's going to save them is if they sell their existing house much higher than their new house, because they're paying a higher mortgage on the new house. But that's not likely to be the case because, again, these are all interrelated issues. Housing prices in the U.S. are not going down despite the higher rates. Why? Because housing demand is increasing. And why is housing demand increasing? Because of immigration. And if you spend any time on X, every day there's pictures of, immigration, I don't know what you want to call it, immigration armies coming in from South America. And the status of the whether they're legal or not, the number of immigrants coming to the U.S. Is mind-boggling. And again, I'm going to tangent myself here, but this is exactly my biggest issue in Canada right now. Is it's not so much illegal immigration in Canada, although that may be happening as the people coming to the U.S. Do they keep going to Canada? I don't know, but the Canadian government, especially the last few years, has been very very active in actually pursuing immigrants, and we had a huge, historically obscene number last year. 1.2 million, I believe, was the total immigration last year, which on when Canada's population base is 38 or 39 million, that's a huge influx of people, and that creates a stimulative demand because these people need food, these people need shelter, these people need clothes, these people need transport, and they're not necessarily producing anything. So you have this huge demand for services, and the new people aren't yet being able to service themselves. So you basically putting a strain on the existing infrastructure. And so what we've seen in Canada, and again, the same story in the US, you're seeing a huge increase in demand for housing. And there's not enough housing stock, and there's not enough workers to make those houses. So what you're seeing is, rapid, gains in housing prices, and then, the rental prices are going up as well. We've seen in Calgary here, National just put out a graph yesterday. I was looking at, and they showed that, Calgary has the highest population growth in Canada of all the major cities in 2023. And it's like the population growth is like 5 or 6% last year. And again, there's just not enough housing. So, mortgage rates have been slowly getting more reasonable, but the fact is that the rents are just now creeping up. And it said there's rent increases of about 10% or higher in Calgary. And I see stories online about people in Toronto 22 or 25% like rent increases. I don't know if rent control is an issue in Toronto, but it's certainly the price increases are dramatic. And this is all to deal with immigration. And it's creating a distortion in the data. So historically, Canada, on average, job numbers and we get job numbers tomorrow for December. But typically, you expect between 5 and 20,000 job gains. If you saw a number like 30 or 40,000 in a month, that was like, holy crap, what happened? And that's been the case for most of my career. But in the last few years, and I've been told, by various people, it's probably because of immigration. It's like you can see if you have this many people coming in. That is going to create, as I said, it creates demand for things. And so, there's the workforce is dramatically increased. And so your job gains are no longer typical of 10,000. You can see 40 or 50,000. And so we have seen several months last year where we saw those kind of numbers. And so the job creation machine in Canada seems to be on fire. And as a result, you would expect, given the Bank of Canada hiked rates, and oh yeah, sorry, this is the other point. In the US, you can buy 30 year, you can lock in a 30-year mortgage. In Canada, you cannot. You have a 30-year amortization period, but you have a 5-year max fixed. So if you want to lock in a rate, even if you locked in 2020, you're subject to reset risk in 2025. And a lot of people, myself included, have reset risk before, I have reset risk in 2025. Other people will have reset risk this year. And as a result, they're going to have to be dealing with a much significantly higher rate than they had to on the previous reset. So how are they going to afford that? And a lot of people were paying top of the market to buy a house. God forbid they got a floating rate mortgage, and they haven't done a fix. So they'd be paying a significantly more in mortgage payments now than they were a few years ago. And there's even a bigger problem here. I'll get to in a second. But so this was expected to cause a massive slowdown in Canada's economy. And you do see like anecdotal stories about, yeah, I can't afford to keep my house. I got to sell my house, or I got to find a secondary income. And there's all these stories about how people are trying to survive these higher rates. So this, in the past, you'd expect the Bank of Canada to say, okay, yeah, we're done. And they only finally said that in December or November last year. Uh, and of course, now the market's expecting rate cuts and they're pricing in probably 5 or 6 25 basis point cuts this year when they start as a debate. They had priced it as early as March, and I think that's been pushed back to June. So um, there's going to be some consideration as to when the Bank of Canada starts cutting. And that's the issue is like, well, people are saying they have to cut because these resets are going to kill people otherwise. And one thing I've been curious about is how come we haven't seen pain already? And it's curious enough to, uh, and this happened in the U.S. as well with commercial real estate. That's a different story. But in Canada, so if you got a floating rate mortgage and um, you're sitting here with higher payments, well, there's an aberration of the floating rate mortgage called a floating rate fixed payment model. So your mortgage obligations go up, but you're still making the same monthly payments. What this does is this increases the amortization period of your mortgage. So you may have started with a 30-year mortgage, and now you've got a 40-year mortgage. And so what the government has been quietly allowing the banks to do on the side is gradually let people that are falling behind in payments increase the amortization. There was a big concern back in 2000, 7 and 8, where people were 35-year amortization periods. Oh, we can't have that. So they mandated a maximum 25-year amortization period. Well, now that's sort of then tucked in the side, and yeah, like on the slide, especially with these people with these floating rate fixed payment mortgages that had no alternative. They either have to sell their property at huge loss, or or whatever hardship, or they wouldn't be able to make these payments. And so the amortization periods have been increased. And that leads to the weird situation. Well, if you have someone with a like 50-year or 60-year mortgage, are they reasonably going to be alive to service that for their entire, they won't be working 60 years, I hope, so do you pass on these mortgages to your kids if they're, so how do these, you're having indentured mortgage holders now where you may have generational mortgages, and that's sort of it sounds comical, but it's not out of the question. So anyway, why I haven't seen a crash yet is because a lot of these amortization periods of the mortgages are being extended. And how long can that go on before it becomes, when the government does say, okay, enough's enough. We can't have someone with an 80-year mortgage. So that's why I'm waiting for that shoe to fall. But in the end, the banks will not let everyone have longer amortization periods because well, I shouldn't say they can't or they won't, but I find it unlikely. But if they don't, then we're going to have major financial pain unless mortgage rates come down significantly. And they have in the last few months, with the Bank of Canada basically saying we're done in the market pricing at a pivot. Now here's the issue with both the Fed and the Bank of Canada. The market has basically been aggressive in assuming that we're going to see rate cuts this year of significant size. And the problem is that the Fed in particular is like so worried about getting their inflation credibility back. They don't want to actually say, well, sorry, they do want to encourage, they don't want to actually cut. So they want the market to do their work for them, which is what we saw in December and November last year. The market pricing in the cuts, which the mortgage rates are based on the bond rates, not the overnight rate that the central bank administered. So the Fed can talk about, yeah, we're pricing in pivots into our dot plot, but then we have another official saying, no, we didn't really talk about rate cuts that last meeting, or we didn't talk about rate cuts at all. We're still worried about hiking. So you're getting this doublespeak from the Fed, where on one hand you've got Jay Powell saying, yeah, like we're done hiking, and we're thinking about rate cuts, and then you have other members of the Fed saying, no, we're still thinking inflation's a risk. So they have to look like they're still concerned about inflation, although they really, in this situation where there's so much, like I said, there's so many people that are underwater on loans that will not be able to finance at higher rates. And so, Peter, why is this a problem? We've had 5% rates before. The problem is that the debt level globally is so much higher than it was, say, even 20 years ago. But when I talk about doing a Volcker, so Volcker raised rates to 18% in 1982. You can't do that now because the level of debt, even the U.S. government debt, was so significantly less in the 70s than it is now. You can't raise rates dramatically like that. As it is, what the Fed has done is probably problematic. So we're in a situation now where we've got uh, again, they have to let the market lower rates, but they can't be seen as saying, yeah, we're cutting rates right now. So they're doing this double speak, which is causing a lot of volatility in the fixed income markets. And you saw the 10-year Treasury got down like uh, what was it, 380, 388 or something in December. And then this, you know, we had the FOMC minutes come out yesterday. You had ADP employment come out this morning. So now they're all pricing back, where the Treasury yield is at 4%. But yesterday it was really weird. We went to 4%, back to 392. Now we're back to 4%. So there's a lot of volatility in the fixed income market. And again, I said there's special situations where in Canada yesterday, the Bank of Canada is doing a repo, overnight repo. So it's an unsettled market. There's a lot of concern about where's the next black swan. And as I was talking about that pawn shop facility with the regional banks, that was a 1-year program that expires in March. So the question is, do they extend that program even more? But there's two problems with that. One, it would not be confidence inspiring to say a temporary program is being renewed. The other issue is because bond rates have come down, uh, the borrowing rate on that, sorry, the rate on that facility to borrow cash from that pawn shop is less than the Fed funds rate. So what's happening in the US right now is banks are basically borrowing from the pawn shop and then investing back in the Fed for overnight, and they're making a 80 or so basis points. It's ridiculous. So there are being this program. So the usage of this program keeps going up and up and up. So it's at the highest level it's been since it was initiated. And so a lot of people are looking at this saying, well, it's not really reflective of the system, problems. It's reflective of, well, it is a problem, but it's not the financial stability problem. It's the banks are making money off this. So again, we shouldn't extend this program. So there's a lot going on there. But ultimately, you said the situation is we do need lower rates for a lot of these reasons I just enunciated. But the data, which is what the Fed and the Bank of Canada and other central banks supposedly base their decision making on, the economic data said that ADP came out today strongly expected. Non-farms probably will be firm tomorrow. The inflation data has been generous for central banks over the last year. It's come down, but that was an oil price spike reflecting in what they call a base effect, where you see a big spike one year. Well, it's going to come down because the price pressure that caused that initial spike is no longer there. So you've seen inflation in both Canada and the US come down, but it hasn't got below 3%, which is sort of, it is the Bank of Canada's firm target, and the Fed has a de facto target there as well. So if inflation remains above 3%, it's very hard for the Fed to say, yeah, we're looking at data dependency, we're going to cut rates, but inflation's still above your target. So how can you justify that? So they will not. This is a reason why you see Fed, New York Fed Williams and others back talking, saying, "Oh, we're not ready to cut yet," because the data, the data itself doesn't justify it. Now, why doesn't the job data? Why haven't we seen a collapse? And that goes back to the immigration story. The immigration is creating artificial demand. Well, it's not artificial. It's people need housing. So if you're going to let all these people come in and they want food, well, there's only so much food in the country. The food prices have got to go up until more food is produced. And if you can't produce more food, you're going to have to import more food. That's expensive. Um, so yeah, like you've got basically a immigration spiked uh, increase in jobs. And the one key thing here is, like, people don't focus enough on the unemployment rate as opposed to the job numbers, jobs created. So in Canada, because we have all this immigration, uh, if we're creating 10 or 20,000 jobs, that's a good month. But if we have 50,000 people entering the workforce every month, then your unemployment rate's going to go up. And that's sort of what we're seeing. Some of the banks that have been sending me outlooks have been basically noting that. It's like, if you keep seeing the unemployment rate go up, it's because there's the number of people entering the workforce that can't get jobs. And again, problem with this immigration, it's not like, and anyone that's familiar with importing foreign workers knows this. It's like, in many industries in Canada, you may be an accountant in India, but you can't get certified to be an accountant in Canada right away. You have to get your certification again. So a lot of professional staff that come in from foreign countries, they're not immediately able to work at the same level they were coming in. And it gets a ridiculous story where you've got people that working, an investment bank in say, Sri Lanka or whatever comes to, it has to be working in a branch as a teller. You got a waste of skill because they have to acclimatize to the new system. So let's just say that the immigration is good, uh, but it's not immediately productive. So a lot of these people are basically going to be a cost to the system before they're actually a productive member of society. Now, why is all this immigration happening? There's a few reasons for it, but if you look at what's going on in Canada, uh, well, it's epidemic of what's going on in industrialized world in general. If one of my favorite topics is demographics, economic demographics, and it's a big driver of, we've had, well, of course, everyone knows that the baby boomers have been, a huge bulge of the population bracket, and that's been driving economic activity for the last 40 years. All these baby boomers are retiring, and the issue is, myself, Gen X, and even whatever Gen Z and millennials, there's not as many of us. So there's a demographic time bomb where you've got all these people that are going to be using the system for support, Medicare or whatever, retirement, uh, and you don't have enough people working to support that. And so there's a guy named Peter Zahan who's on YouTube. He's like a geopolitical strategist. He is always pointing out these demographic issues, and it's one significant problem for, like, Japan, of course. And there's various solutions. Japan has basically decided to export all their jobs to other countries in Asia. So the workforce has shrunk, but they have managed to offset that. So in Canada's case, yeah, what are we going to do? We don't have enough people coming in. I mean, Canada's always had aggressive immigration, but it still wasn't going to be enough to to offset this demographic issue. So now though, the last year or two, it's we're solving a lot of our problems, but it's going to be costly, to get these people to acclimatize to Canada. And again, there's always the issue of, well, are they going to be a real Canadian, or are they going to stay in their little enclaves? And that's not so, Canada's seen as sort of a melting pot, and we've been able to have that where we've had people come to Canada, stay in their enclaves, but also adjust to the general. We don't have like Canada is not like a very like in Japan, it's very xenophobic. Japan is one culture, one mind. In Canada, we have a mix of cultures, and so it's not such a big deal. But it's still going to be a climatization issue. And in places like Europe, you're seeing this play out right now. It's like you've got massive enclaves of people that were guest workers, and now they're needed to stay, and yet they're not your typical German or Scandinavian or whatever. So there's going to be issues, and we saw that in France last year with all those riots. And so that's an issue for Europe, is they have the same problem with population, but they don't have the flexibility to the culture will change, and there'll be people that are upset, like my country is no longer what I know it as. And so the transition for immigration is not going to be as smooth in Europe, and I think we're going to see a lot more issues, and that's also accentuated by the issues of Ukraine, and should they be supporting Ukraine more? And that's another driver of stress. So I'm like, if I'm looking at outlooks now, it's like I'm not confident in Europe. They have all the same problems I just detailed with Canada and the U.S. They have way too much debt. They have way too much government spending to stimulate the economy pre-COVID or post-COVID. They have all these financial institutions under strain, and we saw that with UBS and Credit Suisse. Credit Suisse being basically jettisoned, and there's going to be other financial institutions that are under similar pressures. So you're going to have major issues in Europe. And so if I had to go a forecast for where I see euro going, I'd say would underperform both the Canadian dollar and the U.S. dollar. And I guess, yeah, that's since I'm a currency guy and I haven't talked about the dollar at all. I guess that's where I'll finish off this little talk before questions. So what is going on with the dollar? If the US is printing all this money, how is the dollar so strong? Like, why? And in fact, we actually saw the trade weighted index in late 2022 go to like 117. And that was actually a big issue because uh, the dollar is so strong that like a lot of countries borrow in US dollars because it's cheaper to borrow in US dollars than it is their home currency. So there's massive offshore US dollar debt. And what happens when the US dollar appreciates? They need to buy more dollars to make payments. And then the US is raising rates. They need to have more dollars because now their interest payments are higher. So it creates a bit of a global debt problem. And if we thought we had a Latin America debt crisis in the 90s, then this would be a huge extension of that. And so you saw in like 2022, unusual comments from the World Bank and the IMF, hey, Fed, stop hiking rates. So it's not very often that you see these institutions comment on monetary policy, but they were, because they were really worried about an implosion of global debt markets. And as a result, not that the Fed listened to them, but it was a big concern. And there were some speculative issues that were going on with that. Um, but the biggest problem at all was you. So Japan is basically the biggest holder of U.S. Treasuries, and Japan has basically been. They were the poster child of QE. They did QE before the U.S. even considered doing it, and they've been doing it since the 90s. And their economy has been sort of on life support, and monetary policy has been keeping rates near zero. And again, this is partly the demographic issue. There's just not enough people that are young and need stuff. So the domestic demand in Japan is very slight. And this is why, again, Canada has sort of sidestepped that with all its immigration. But in Japan, they had to have low monetary policy, low rates for longer. And so as a result, there's been what's called the carry trade, where you borrow in yen and then you invest in the US. And when the US is raising rates and Japan is keeping rates zero, that puts pressure on the dollar yen, and that helps US dollar strength. And you could argue that the same process was going on in China. So China was basically, they were never recovering from COVID as fast as the U.S. had. And so they were trying to stimulate the economy by keeping the rates low. Meanwhile, the U.S. is hiking rates. So the renminbi started selling off. And the Chinese have been trying to actively manage the renminbi, or yuan, or whatever you want to call it. Uh, but even so, it's like it's the same pressure. And there's also been another switch that is topical. So again, there's so much to talk about. I'll try and keep it short here. When Russia invaded Ukraine, the U.S.'s response was to freeze Russian assets and basically seize all Russia's foreign exchange reserves. So Russia is like, okay, we cannot rely on the U.S. dollar as a mode of transaction anymore. So we have been like, it's basically, the SWIFT system has been, weaponized to be against us. So Russia started talking with China and other countries about, yeah, like we want to get off the U.S. dollar entirely. We want to create our own currency or some way of exchanging with where we don't be exposed to this anymore. And the U.S. can't use the dollar as a weapon. And so as a result, you've seen all these headlines about BRICS, and you're seeing basically formation of an alternative currency system. And that takes a long time. And one of the reasons the strength of the dollar is because it is the capital markets, mechanism. There's no other capital markets that's deep enough for what the world needs than the US dollar. So, China has been trying to build a derivative market in Shanghai with oil futures and gold, and it's taking time, and it will take a long time. So is the US dollar under threat from this? Yes, but not immediately. And that's the issue is it takes a long time for trade networks. Like if you're Ghana and you want to buy oil, uh, Saudi Arabia had priced that in dollars. Now Saudi Arabia is saying, yeah, like we kind of going along with this. If you want to price this in yuan instead, okay, we'll do something other than dollars. And so as more countries start doing transactions not in dollars, then the demand for dollars will dry up. And financing for those contracts will no longer be in dollars. It'll be in yuan or whatever currency it is. And that, as a result, will over time reduce demand for dollars, which will weaken the dollar. But that takes a long time to play out. And we don't know how long that's going to be. It could be a year, could be 10 years, could be 10, 20 years. Depends on how fast things are going. But we're seeing constant headlines on Twitter or X or whatever. Every day there's a new brick announcement. So it's gathering steam. And in countries like Russia and China who are trying to challenge the US dominance, they have vested interest in trying to promote this. So it's not going to go away as long as there's geopolitical problems going on. Russia will be very unlikely to go back to using dollar assets anytime soon unless they are given a great deal. And I just, with current leadership there, it's not going to happen. So anyway, the US dollar is still strong, but if the US continues to spend like it's doing and the US deficit just the US debt just dropped 34 billion, trillion, 34 trillion at the end of the year, and that's up 30 from 33 trillion in basically 6 months. So they had all this hubbarub of the debt ceiling that was basically removed till 2025. And what happened since the debt ceiling's removed, they added an extra trillion in debt. And there's also like spending caps for the year. And it's like, oh, we can't afford to send more money to Ukraine. So they had this big uh, mid-November, there was an issue with like getting the spending approvals, and that was circumvented. And they had like the U.S. speaker dilemma, and they had to get that resolved. And so anyway, those things have only been pushed back to mid January, late January. So we're going to see in a few weeks this whole rhetoric about U.S. spending limits come up again, and we'll have to get through that again. So there's all these things about what how good a borrower is the U.S. And so as a result, we finally saw Fitch last year reduce the U.S. credit rating from AAA to AA, or sorry, AA plus, whatever. But they're no longer AAA with Fitch. And then this year, Moody's at the end of the year finally said, yeah, okay, all this scribbling is enough. We're going to put you on a negative outlook, which is one step away from basically being downgraded. If the U.S. loses AAA rating with all three rating agencies, then really it's like that does create problems because a lot of investment funds are like that buy treasuries because they are forced to buy AAA names, and there's only so many AAA names out there. So you're going to have this. Well, do I accept worse credit or do I not buy treasuries anymore? So, and then you're seeing countries like China actively trying to get out of the treasury positions as slowly as they can because they have too much. And if they sold them all at once, it would cause a massive problem for them. So anyway, as I said, there could be a dozen other topics I could talk about, but at the interest of time, and I'm already 20 minutes over, I'll leave it for questions here.
Does anyone have questions for Peter?
Yeah.
No?
Don't be shy.
Got a shy group?
I actually had a question. Um, I'm just curious, Peter, what are the types of things you look at when you wake up in the day, when you want to see what's going on in the market, how you analyze pretty
Yeah,
much what's going on in the world?
yeah, and the key to this for my career is like don't rely on one source. In the old days, I used to just read like all like three or four different newspapers, and so Financial Post or whatever, Globe and Mail, New York Times, all that. And I've gotten away from mainstream media somewhat. For all its nonsense, Twitter X is a good source for me for various random headlines, just because you have so many different providers. And again, you have to do a data verification, which is problematic at times, but there's a lot of information to be gleaned from X. And again, I used to use LinkedIn a lot for that too, but you find the information is usually better, but it takes longer to come out. So you don't get instant headlines on LinkedIn. You do get longer term trends. And then yeah, like I don't rely on YouTube that much because I find there's just a lot of amateur content that is misinformed or is what they call pumper dumpers or whatever you want to call them. It's very much amateur hour. So I insofar as I do rely on sources, and that's one thing with X. You get people referencing things like zero hedge articles or Barron's or Forbes or whatever. So I just find it trying to get a broad swath of information from a lot of different places. But the first thing I do when I wake up in the morning is I pull up, well, God, Market Watch is sort of owned by uh, some hedge funds such as Citadel. So it's got some biases in its reporting, but I do find that, the Market Watch page, I look at DXY first of all, and I look at US 10-year, and I look at where oil and gold and silver futures are and where what's going on with Bitcoin. Again, you just open up X and from the people I follow, I see like instant headlines. Oh, Bitcoin dropped $3,000 on nothing. Yeah, it's okay. So it's going to be one of those mornings. So that's sort of how I get started. And then as a benefit of where I work, I get a lot of market commentary from dealers in Toronto and New York. So I do get a lot of information that most people will only see through BNN and not they will. I get a lot of detailed information through my job, which is helpful. Um, but yeah, like in general, just trying to keep abreast of trends. It's ridiculous, but Elon Musk is sort of correct. Is like X for me is supplemented the mainstream media, and it's I noticed it first in politics. For like I used to watch CNN and read CNN online, and it's like these stories are so one-sided, and then it was just politics at first, and then it became like economics and I see it in like, like I'm noted for being, a supporter of AMC. And it's like, wow, the media coverage on this stock is so one-sided. So it's really hard for me to want to read MSN, or any kind of mainstream media because I just find it's very hit and miss these days. But I still think it has its place. But for me, I try and look as many information sources as possible.
Awesome, thank you.
Does anyone else have any questions?
Got a question. Where do you think interest rates are going to end up this year? Are they going up, going down?
Yeah, and that's the topic, right? I made a New Year's post about this. So a lot of the people, a lot of the mainstream analysts were basically saying this market has got ahead of itself. Pricing in three or four or five, six cuts is ridiculous. Look at the data; it doesn't support that. And so they were shocked when the Fed dot plot in December actually pointed to three cuts, and then Powell was basically dovish in his testimony in December. So they were taken aback by that. And yet now we're seeing some take back of those pricing in the last few days. So they're saying, aha, we were right. So I honestly think, as I sort of tried to outline in my talk, I think the Fed wants to encourage the market to price it lower, but they're going to be slow in doing so. If they've got any kind of excuse to delay, they will. So while the market's talking about a possible cut in even March or April, I don't think that's likely. I think you probably see one tentative move in June, and that is if data stays sort of as it has been. If inflation spikes up to like from 3.1 up to 5 again, not going to happen. No hikes are going to happen if inflation needs to go back below 3%, and then we'll actually see a significant rate cut. So if you see it staying around 3 to 3.5, you probably see a 25 basis point cut by the Fed in June, and maybe one in yeah, late August, September, and then maybe a third one in December. So that's my outlook for Fed. And the Bank of Canada has been leading the Fed in terms of policy moves, but I don't see them doing, again, when you have this kind of immigration going in Canada, it's like it's obscuring a lot of trends. So I don't know if the Bank of Canada is going to arbitrarily start cutting faster than the Fed. I think they'll probably wait for the Fed to go and then they'll go as well. So I'm thinking the market's got pricing in about 150, 175 basis points in cuts this year. I think you're probably likely to see 75 to 100, but again, probably won't happen in March. And at earliest May, maybe June. But again, it really depends on the data.
Right. Thank you, Peter. Does anyone else have any questions? No? Okay. Comments? Okay, I have a question. So, Peter, comparing Alberta to BC, so if we're in BC and we're business owners, what should we be aware of? That's one question. Second of all, why the massive influx into Calgary? Was that because all the housing went down? It was cheap? It was a ghost town? Or
Well, yeah, so as like again, I'm not going to get into the politics of BC and Alberta, but my sense is that in general, you're going to have higher taxes in BC, and you're probably going to have higher gas costs and stuff, just because uh, just the traditional reasons that Alberta's the oil producer, and so things are cheaper here for us. But in general, like why Alberta as opposed to like a large part of it was, yeah, Montreal, Toronto, and Vancouver had already seen excessive gains. And so what happens typically is when people come immigrating to Canada, they're looking at, well, who do I know in Canada? I'm not coming to Canada because well, some people do, but most people have family friends already here. And where are those people already? They're already in Ontario or they're already in BC. So predominantly, we've seen most immigration come into those two places. And then as Toronto and Vancouver got expensive, Montreal became like the next. Okay, we can't afford to live in Toronto, but Montreal's nice, and a lot of it's also real estate speculation. The government's basically put in a law about foreign buyers, but that doesn't stop domestic people from speculating. And so, if Toronto is overpriced, well, I'm going to buy a dip in Montreal, and then they're going to flock. People are going to come to Montreal, which has been the case. So Montreal has taken off over the last few years. It's kind of funny because when I was working with you in Vancouver, I did a presentation, and that's exactly what I said at that presentation in 2018. I said, like, Vancouver and Montreal, Vancouver, Toronto are too expensive. Montreal's the next target, and it was. So when you
I
get,
actually remember that, Peter. I
yeah,
remember that. Yeah.
yeah, I think the ladies that organized it was Tina. I can't remember her last name,
Yeah.
but
Yeah.
yeah. But yeah, so we're sitting here now. Well, Montreal's expensive. What are the next tiers? And so Calgary is probably on that second tier below Montreal. I mean, you could argue Ottawa, but like in the West, um, you're targeting Victoria. Victoria is already expensive, and it's not that well known to immigrants anyway. So, but Alberta has again a large amount of immigrant workers anyway because we've needed it for the oil industry, for farming, and for the cattle, particularly food processing. So there's been a lot of immigration to Alberta already, and so yeah, like Calgary, obviously, as much as I love Edmonton, Calgary is more well known internationally and is economically more diverse. So people are going to come to Calgary, and again, so where you see like if you're going to choose between Saskatchewan, Manitoba, Alberta, Alberta is the best known of those three, and then again, Calgary's best known, Edmonton. And so, I'm surprised that, like, I personally am a big booster of Saskatchewan. I think they have a great resource diversification. It's not sexy internationally, so people don't want to move to Saskatoon or Regina. They just don't see.
There's a huge spike in Nova Scotia and PI, like,
Yeah,
3, 4 times housing, used to be cheap. Now it's not. So,
yeah,
yeah.
and so we're going to see this across Canada, but it'll be like in tiers, and so Calgary is now benefiting or suffering. Actually, having seen my rent go up, I think it's a good and bad news. But so I think you're going to see like yeah, like PEI. I don't know much about the economy there, but Halifax in general is like yeah, Halifax is probably on tier with Calgary. So if you're looking for Atlantic Canada, you would pick Halifax, and if you're looking for the prairies, you look Calgary. I mean, at some point it'll go like Edmonton, and then you'll see Saskatoon, and then you'll see Regina and Winnipeg. So I see like this trend of immigration, unless the Liberal government is booted out and the Conservatives say no immigration, which they won't. They'll just say like we got to slow this down. But I think it's not, you know, I think both governments are agreeing that immigration is necessary given the demographics. And that, so for me, it's like I know a lot of people say the Liberals are politicizing immigration, they're just trying to get votes, and there's some truth to that. But I think in general it's good for the Canadian economy in the longer term, but in the short term it's causing massive pain for a lot of people. So yeah, the Bank of Canada has got to cut rates, and if they don't, it's because there's there's too much inflation from housing. But that's the issue. How should the Bank of Canada address this? Should they base policy just on housing costs, or should they be excluding housing costs in their determination? And is the government going to do more than, like, they've created this idea that we're going to resurrect the 1940s idea of creating these mini homes, standardized cookie cutter, ATCO homes type facilities, where you have like 20,000 pre-made houses on the edge of a city, is not going to solve a problem. I don't know, but that's sort of, the government does need to start thinking about this seriously. If they want to keep jamming people into the country, they got to have a place to live, right? So that's a big concern. It's kind of complicate the Bank of Canada decision. So, but
Well, thank you, Peter. We're at the top of the hour, so thank you as always. And where can people find you on X?
So yeah, my name on X is Peter R. Hann 1. Don't ask me why I put the 1 there, but yeah. Anyway, that's my link X address, and on LinkedIn, it's basically just Peter R. Hann or Peter Hann CFA. So you should be able to find me on LinkedIn.
Okay, thank you, Peter, and thank you everyone for attending. I will be sending out a link to this recording, and we'll post it on LinkedIn as well.
Great, and
Thank you,
thanks
Peter. That was
everyone.
amazing. Really valuable. Thank you so much for your time.
You're welcome.
Thank you.
Thank you, Peter.
Thanks, Peter. That was